Let me start by stating the obvious. War and bloodshed are always terrible, and the only outcomes we should all be hoping for are peaceful ones. Nobody wins when tanks and rocket launchers start rolling across international borders. Nobody. The effects of the Russia-Ukraine war are being felt across the globe, not only in the pain and suffering of the conflict itself, but the economic impact on everyone's daily lives. The prices of basic necessities are skyrocketing. Since February 24th, when Russia invaded Ukraine, the price of oil has gone up by almost 40%. The price of wheat has gone up by almost 50%. These are not growth stocks, they're commodities that humanity relies on. War is also complicated. The Western response to Russia's military actions have been largely in the form of economic sanctions, further inflating the prices of these same commodities. Add in already record high inflation and fears of a recession, and it's easy to see why people are afraid for their financial future. With all of these headlines about war and inflation and recession, I wanted to try to answer one simple question for myself. Is it a good idea to invest during times of war? After a lot of digging, I found my answer. Stick around till the end of the episode, and I'll share Warren Buffett's answer to this same question. Your time is valuable, so let's get right into it. I should make it clear that I'm not the right guy to tell you about this war, or how it could play out. My background is in data science and math, and I make spreadsheets in my free time. I'm really fun at parties. I decided to hunt down how the market has handled similar situations in the past. I found this great list of major crises, how they affected the Dow Jones, and how long it took the index to recover. This list goes back 80 years, starting with Germany defeating the French in 1940 and ending with the pandemic shutdowns of 2020. I noticed an interesting pattern in this data, so I copied it into a Google spreadsheet and got to work. But first, let me give you a couple important details about the data itself. This data shows the number of trading days that the Dow Jones took to bottom. This is really useful because actual crashes tend to be very fast, while recoveries tend to be much slower. For example, it took 23 trading days for the stock market to bottom when the world closed down in 2020, but it took around 160 days for it to fully recover. Remember, if the stock market goes down 33%, it actually needs to go back up 50% to make a full recovery. And that's exactly what this average shows us. It takes 18 days on average for the stock market to bottom, but it takes around 6 months on average for it to make a recovery. The second thing I want to point out is that the Dow Jones, the S&P, and the Nasdaq largely moved together. For example, year to date, the Dow Jones is down around 9%. The S&P 500 is down around 11%, and the Nasdaq is down around 17%. Not only that, but they tend to react to the same things in the same ways. So even though this data is about the Dow Jones specifically, it's useful for investing in general. Okay, with that out of the way, let's talk about the pattern in this data. Let's turn to my Google spreadsheet first. If we sort this data by the number of days the market took to bottom, the longest crashes were the Russian and long-term capital crisis in 1998, the Arab oil embargo in 1974, the Hunt silver crash in 1980, and the Lehman Brothers collapse in 2008. On the opposite end of the spectrum, we can see events like the JFK assassination, where the market snapped back in only a single day. I'm actually not sure if that says something about JFK or the stock market. Anyway, if we sort this table by the depth of the bottom instead of the time it took to get there, the biggest drawdown on the list was actually the most recent one, when the world closed down in 2020 due to the pandemic. Right after that are the stock market crash in 1987 and the Lehman Brothers collapse again. The thing that these longest and worst drawdowns all have in common is that they were economic crises, not armed conflicts. So I spent a little time researching each crisis to see if they were mostly economic or mostly armed conflicts, and there was a pretty even split. Then I found the averages for each category instead of looking at them combined. It turns out that the Dow Jones took 27 trading days on average to bottom from an economic crisis, but only about 10 days to bottom from an armed conflict. The bottom from an armed conflict is also much less severe, dropping around 6% compared to a 19% drop for an economic one. That's a pretty interesting pattern, right? So even though it takes the market about 6 months on average to fully recover from a crisis, that's a bad estimate. It takes about 3 months to recover from an armed conflict and about a year to recover from an economic one. They just happen to occur in roughly the same amounts over the last 80 years, according to this one dataset. The next thing I wanted to see was if there was ever a case where the Dow Jones didn't recover by the 3, 6, or 12 month mark. There were only 5 events on this list where the Dow Jones wasn't higher 3, 6, or 12 months later, 4 of which were before the stock market really went online. The one other case where the market didn't fully recover within a year was the financial crisis of 2008, where it took the Dow Jones over 5 years to recover. Yikes. Still, 24 out of 29 times the market has made a full recovery within 1 year, and usually much sooner. If you only count the last 3 decades or so, from 1990 through today, the market recovered within a year every single time except for the 2008 financial crisis. So the question here isn't really if the market will recover, but when. And that really depends on whether the US stock market is pricing in the Russia-Ukraine war as an armed conflict or more of an economic crisis thanks to all the sanctions and price inflation that's being built on top of it. This is why it's so important to have a long-term mindset when it comes to investing. It helps you worry less about exactly how these uncontrollable events like wars and oil prices will actually shake out. Speaking of long-term mindsets, I also wanted to see what advice the best investors in the world could offer in this situation. It turns out that Warren Buffett bought his first stock in 1942 during the heart of the Second World War. Talk about investing during a crisis. That means Warren Buffett was also investing during almost every single crisis in the data that we just covered. Well, when Russia annexed Crimea back in 2014, Buffett was asked about investing when there was a threat of World War III or a possible return to the Cold War. Here's what he said. "If you tell me that all of that is going to happen, I'd still be buying stocks. You're going to invest your money in something over time. The one thing you can be quite sure of is that if we went into some very major war, the value of money would go down. That's happened in virtually every war that I'm aware of. The last thing you'd want to do is hold money during a war." According to numerous studies, inflation typically rises sharply both during and in the aftermath of major wars. Median inflation peaks 1 year after serious wars at about 8%. And it can be at 5% or higher for the 3 years leading up to the end of a war and the 3 years after. That's why Warren Buffett says you don't want to hold money during a war. When you think about humanity's track record for war and the fact that our economies are now more connected than ever, this could be a good argument to almost never hold more cash than your investment strategy demands. Also, don't forget that we are already near record high inflation before this Russia-Ukraine conflict even began. In his 2014 letter to shareholders, Warren Buffett also warned against this kind of short-term thinking that was gripping investors during the Russia and Ukraine conflict back in 2014. Forming macro opinions or listening to the macro or market predictions of others is a waste of time. Indeed, it's dangerous because it may blur your vision of the facts that are truly important. So, hopefully this episode provided you with some clarity around how markets behave during armed conflicts and economic crises, as well as some great advice from one of the best investors in modern history. If it did, consider liking this video and subscribing to the channel with all notifications turned on. That's a great way to let me know that you enjoy this kind of research. And if you're looking for quicker insights every day, I'm always posting new content to Twitter, Instagram, and TikTok. Yes, even TikTok. So go follow ticker symbol U on whichever channels you're already enjoying surfing. The stock market has been incredibly volatile lately, especially high-tech growth stocks. If you want to learn more about this area of the market, check out this episode next. Either way, stay long, stay strong, and thanks for watching. Until next time, this is ticker symbol U. My name is Alex, reminding you that the best investment you can make is in you.